Unit 4. Economic Categories. This chapter is designed to introduce concepts of economic categories, their classification and basic features to the learners. After acquiring knowledge from this unit, learners will be proficient in basic concepts of economic categories, able to identify the characteristics of economic categories and their basic classification. Accounting categories and terms are defined by accounting standards. These are the principles and rules of recognition, measurement and classification of business events and the preparation and presentation of financial statements. Accounting standards are not static. They are being continuously complementing and changing, parallel to the development of accounting theory and practice. Croatia is applying domestic and international financial reporting standards as accounting standards and are subject to the Accounting Act. The Croatian standards are established and interpreted by a professional body, the Financial Accounting Standards Board, while the international financial reporting standards are regulated by the European Union regulation. According to accounting standards, accounting categories include assets, liabilities, capital, income, expense, profit. Each category will be briefly described below. A asset. An asset is a resource or property having a monetary economic value, owned by an individual or entity, which is capable of producing some future economic benefit. Assets are generally brought in business to benefit from them and to increase the value of a business. An asset may be used individually or in combination with other assets in the production of goods or services that an entrepreneur will sell, exchanged for another asset, used to settle obligations or divided among the owners. Assets are reported on a company's balance sheet, and they are bought or created to increase the value of a firm or benefit the firm's operations. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, improve sales, regardless of whether it is a company's manufacturing equipment or a patent on a particular technology. One of the classifications of assets is based on their physical existence. According to this classification, an asset is either a tangible asset, intangible asset or money. According to classification of the assets based on their function and a lifetime, there are two types. Fixed assets. Current assets. Fixed asset is something that is expected to continue to be productive for a business for more than 1 year. An entrepreneur uses it in his business. During usage it is gradually wearing off and depreciating, but does not change its shape. Fixed asset can be in the form of intangible assets, tangible assets, financial assets and claims with a due date of more than 1 year. Intangible fixed asset is a non-physical asset having a useful life greater than 1 year. This asset may be in a physical form and in the form of a contract, etc. Intangible fixed asset includes R&D expenditures, foundations expenses, concessions, patents and licenses, trademarks, investments in other assets, goodwill, prepayments for intangible assets and others. R&D expenditures are expenses used for the research and development of new products and technologies, results of which are expected to be used for more than 1 business year. Patent is a set of exclusive rights granted to an inventor for the invention, which is a solution to a specific technological problem. Patent is recognized for the inventions relating to the product, process or application. When patent protection is granted, the invention becomes the property of the inventor, which like any other form of property or business asset can be bought, sold, rented or hired for a limited period of time. The rule states that it may not last for more than 20 years from the date of filing the application, after which it becomes public good. Patent can be reported on the balance sheet under intangible assets only if it is acquired from others. License is the purchase of a permission, that is a license to use one's patented invention or a protected intangible asset. The time right to use or the right to produce a certain amount of product is determined by a license agreement that is legally regulated by the Civil Obligations Act. Franchise is a right acquired by paying a fee for a particular business. It is considered to be a fixed intangible asset because as it is prepaid for multiple business years. Concession is a contractual right when one party grants another party goods or the rights of their economic usage and the other party pays the fee for those rights. Trademark guarantees the owner exclusive right to place on market the products and/or services identified and are protected by its recognizable sign. The trademark protection in Croatia, as well as in many other countries, is valid for 10 years, counting from the date of filing the application. The protection rights may be unlimitedly extended for periods of 10 years, provided that the application is filed on time, generally before previous 10 years have expired, and that corresponding fees and charges are paid. Goodwill is the difference between the value of a company on the stock market at a certain time and its accounting net set of assets. It is an intangible fixed company's asset, which enables it to make a higher profit than the normal or classic profit rate made by other similar type of companies. Tangible fixed asset is an asset that has a physical form. It includes land, construction facilities, plants and equipment, tools, operating inventory and transport assets, residential buildings and flats, repayments for fixed tangible assets under preparation. Belak, v. 2006. Professionalno rukovodstvo. Zagreb. Deloitte. STR 156. Fixed, long-term, financial assets are shares in affiliated entrepreneurs, loans given to affiliated entrepreneurs, interests, investments in bonds, loans, deposits, personal shares etc. Current, short-term, assets are expected to be converted into cash in a very short time, usually within 1 year. Commonly they include money, investments in active securities and supplies. Current assets appear in all three basic forms: goods, rights and money. The balance sheet of the current, short-term, assets includes supplies, short-term receivables, from customers, affiliated companies, employees, government. Short-term financial assets, received short-term securities, checks, bills, short-term given loans, given deposits, shares in affiliated companies etc. Cash and cash equivalents, money in the bank and in the cash registers, foreign currency payments etc. Actual time delays, prepaid costs for the future periods and undue revenue collection. B. Liability. A liability is a company's financial debt or obligations that arise during the course of its business operations. Recorded on the right side of the balance sheet, liabilities include loans, mortgages, obligations towards suppliers, deferred revenues etc. According to the International Accounting Standards, the liability is defined as the current obligation of the company resulting from past events. The settlement of those liabilities would result in the outflow of resources containing economic benefits. Liability is the duty or the responsibility to act or do something in a certain way. Liabilities can be legally enforceable and can be derived from business practices. Payoff of the current liability can be accomplished in several ways: by cash payment, by transferring another asset, by providing services, by replacing one liability with another one, or by creditor losing his rights or waiving them. According to the payment deadline, there are two types of liabilities. Short-term liabilities are expected to be settled within 1 year, counting from the balance sheet date. Short-term liabilities include liabilities for received loans, deposits from citizens or other companies from the country or abroad with a payment deadline of less than a year. Long-term liabilities are usually incurred for the purpose of acquiring long-term assets, or refinancing long-term assets that have not matured. See capital. Capital refers to financial assets or the financial value of assets, which is left to the owners after all liabilities are settled. In the case of a joint stock company, the capital is expressed as a share capital, and when it comes to a limited liability company, limited, it is expressed as a registered basic capital. The balance sheet is breaking down liability into the registered capital, capital reserves, revaluation reserves, retained earnings, profit or loss brought forward, the earnings or loss for the current year. Capital can be invested in several forms. Money, by paying to a giro account of your company. Things, by putting the plant, equipment, supplies etc. into your company. Rights, by entering a patent, license or some other right into your company. Regardless of whether it is a joint stock company or a limited liability company, the capital includes equity capital brought directly to the company by owners. Earned capital. The earned capital is the result of business activities of the entrepreneurs. It is the difference between income and expense after taxation, that is after payment of capital gains tax. Based on the decision of the company's management, instead of being paid to the owners, the earned capital can be transferred to retained earnings. There are several ways to increase your own capital: by bringing the new basic capital to the company, by new members joining the company, by recapitalization, that is by increasing the basic capital by the existing members of the company. In the case of joint stock companies, DD, with public offering and capital gains. Capital reduction occurs in the following cases. Current year losses. The payment of gains for the current year or retained earnings of previous years to the owners, that is the payment of dividends to shareholders in the case of the joint stock companies. The repayment of the stake from the basic capital to the investor who exits the company. Impairments from revaluation reserves of reduced value of already revalued long-term assets. D. Income. Income is the gross of cash flow, claims or other benefits arising from the regular activities of the company from the sale of goods, provision of services and from the use of resources of other companies that make interest on royalties and dividends. Income is measured by claims from buyers and customers for delivered goods and services performed, and by fees and merits resulting from the use of buyers and customers' resources. Amounts charged on behalf of third parties, such as certain taxes, are excluded. In a representative relationship, the income is the amount of commission, rather than the gross cash flow, claims or other fees. Income recognition mainly refers to the situation when the income is recognized in the company's profit statement. The amount of the income deriving from a transaction is usually determined on the basis of an agreement between the parties involved in the transaction. When there are uncertainties regarding the determination of the amount or the related costs, these uncertainties could affect the determination of the time of the income recognition. Income recognition requires that the income can be measured and that its final collection can be expected at the time of the sale or providing services. The real expectation of the final income collection does ensure that payment by itself. Where there is not possible with certainty to estimate the payment at the time of sale or provision of services, the income recognition is delayed. In such cases it is appropriate to recognize the income only when money is received. If there is no uncertainty when it comes to the final collection, the income is recognized at the time of the sale even when cash payments are made in installments. The main types of income are business, financial and supernormal profit. Business incomes are made during the regular company's business, that is by selling finished goods, by providing services, renting land, business premises etc. Financial incomes are made through positive exchange rate differences and interest rates for lending financial resources to a legal or natural person. Supernatural profit was not generated by the company's regular business activities. This type of income includes excess of materials, income from penalties etc. Expenses. Expenses are decreases in economic benefit during the accounting period in the form of a decrease in asset or an increase in liability that result in decrease in equity, other than distribution to owners. Recognition and measurement of expenditures depends on the concept of capital and its preservation used by an entrepreneur when compiling and presenting financial statements. Expenses are recognized in the income statement when the reduction of future economic benefits results from a decrease in assets or an increase in liabilities, and which can be reliably measured. This means that the recognition of expenses occurs at the same time as the recognition of an increase in liabilities or decrease in assets. The main types of expenses are business, financial and supernormal expenses. Business expenses are the result of the company's core business and their level depends on the volume and type of business. This includes the costs of production incurred due to the effects making, the purchase of merchandise goods, administrative expenses and other expenditures needed for basic business processes, purchase and sale expenses, if specifically accounted for, and subsequent adjustments to costs that are accounted for as operating expenses. Financial expenses are the result of obtaining, using and reimbursing financial resources. Financial expenses include negative interest rates, negative exchange rate differences, a decrease in the value of long-term and short-term financial investments and the coverage of the negative balance of revaluation reserves. Supernormal expenses are the result of unplanned downsizing of business assets or unplanned increase in liabilities. Most often they are the consequence of irrationality from the previous period or because of the influence of the environment. They do not occur when creating effects. This means that they do not result in new values and they do cause the decrease in business results. Business result. The business result represents the success of an enterprise expressed by monetary scales. Comparison between income and expenses reveals the financial results. When the income is higher than the expenses, then the financial result is positive, gain. Loss represents a negative financial result when the expenses are higher than the income. According to accounting regulations, the company establishes a net gain in the amount of difference between the established profit and profit tax. In the case that the established profit before tax is not sufficient for taxes and contributions, a net loss is established in the amount of difference between the amount of tax and the established profit. If before taxation a loss is recognized, before the taxation the amount of the loss is increased for the amount of profit tax, and a net loss is established. After determining the business results, and based on a written decision of the owner or management, the profit is distributed and the loss compensated. In the case of a loss in the business, it is reimbursed from reserves, retained earnings from previous years, etc., in order to enable further business operations. When it is not possible to cover the loss, a bankruptcy proceeding is initiated, followed by the liquidation of the company. Investment advisor needs to understand the different economic categories in order to be able to talk about business investments. To read and understand the financial statements, plans, projects, etc., it is necessary to understand the concepts of economic categories and to be able to identify their features. Financial reports content, balance sheet.